Today we're going to talk about the bull call spread and the bull put spread. These are two option strategies, and I'm going to talk about when you should use them, what the advantages are, what the disadvantages are, and some key components of each strategy. Now, this is something that we use in Freedom Income Options all the time. We use both strategies. We balance them out to help traders replace their income with options. And so stick around. You're going to learn how to use these strategies to replace your income with options. All right, so let's start by talking about the bull put spread. What is a bull put spread? Well, it's when you sell a put option and you buy a put option at a lower strike price. And the strike price is simply the price of the stock that you're buying or selling the option. So in this example, we're going to talk about the SPY, and we're going to sell a 598 and we're going to buy a 597.5. And what that's going to do is it's going to pay us a credit, a 12-cent credit. And the cost of that option in all of these spreads, the cost is the option on the price of the spread. So you can see here that the price is 50 cents. So we have to pay 50 cents for the option. Now, that would be $50 because one contract is 100 shares. So therefore, it's $50. And so in this situation, we get a credit of 12 cents. And where does that, one of the key benefits is that we know what our risk is because we minus the 12 cents from the $50 and we get a total of 38. 38 out of 50. So our risk is 38 and our profit is 12. Now, a couple key advantages of, well, actually, before I talk about advantages, let's talk about why you would do this. Okay, you want to do this if you believe that the price of the stock is going to stay the same level or if you think it's going to go up, right? So it's a high probability trade because you have two different ways that you can win. If the market goes sideways, you can win. If the market goes up, you can win. All right, so those are two out of the three options. The only other option is if it goes down. So that's a high probability. Now, to increase the probability even more, we do this on stocks that are very strong, right? Very bullish, high-powered stocks like the S&P 500. You can see that most of the time, if we look at a chart, if we look at a long-term chart, monthly charts, S&P 500 goes up most of the time. And so that, again, increases our probability. Another way that increases our probability is our expiration date. So when you're buying a bullish put spread, you have to choose an expiration date of when the option expires, when it's no good anymore. And so the further out, the higher probability that it's going to maintain above that level. And so I like to do it with our Freedom Income Options traders. We teach them around 30 days. And so those are some of the key reasons why we would do it. Another nice benefit about it is that you get paid instantly. You get the credit right on the spot, which is always nice. And time decay, which is also known as theta, it works in your favor. As time passes, your spread benefits from losing its intrinsic value. Now, it's not all rainbows, butterflies, sunshine, and unicorns all the time with this strategy. Every strategy has its good and bad. And so some of the risks of this strategy are limited profit. You can only make the 12 cents. That's it. So you're risking the 38 cents and you're only going to get 12 cents, right? So, but with a higher win rate, it is an offset. Okay, so the losses are also limited to the spread. Like I said, you get 12 cents, the spread is 50 cents, so you minus 12 for 38, and so that's how it is actually limited. And if we take a look at this image here, it demonstrates that really well. You can see that the green area is the amount of money that you get, the credit, and the red is the risk, right? So it's risking 38 cents and it's making 12 cents. Now you probably see these charts all the time, and I used to look at them all the time, and it made no sense to me until someone explained it, and now I get it. It makes a lot of sense. Okay, so the key takeaway of bull call spreads is that they're a great strategy. They're really good for consistency. They're good for high win rate. They're good for slow growth of your account, which is our key core concept. Is we're trying to hit 1% a week, and that seems like it's not a lot, but if you do that every week for 52 weeks, that's about a 67% return on your investment. All right, now that's the bull put spread. Let's check out the next strategy that we use at Freedom Income Options, and that is the bull call spread, right? And so the bull call spread is different in the fact that it's called a debit spread, so that instead of collecting your premium up front, you're actually paying to enter the trade. And so here's how this works. You're going to buy a call, and in this case, we're going to buy the 598, or actually, excuse me, we're going to buy the 597.5, and we're going to sell the 598. Have to do the difference of the spread, and it's a 50-cent spread again. But in this case, instead of receiving the 12 cents, we're paying the 39. We're essentially taking the opposite on this. Okay? Now, in this case, it's nicer because you pay up front, but the benefit is that it's a lower capital requirement. Normally, you have to put up the collateral for the spread. In this case, you just pay for the cost of the credit. So it costs $50, but in the call debit spread, in the bull call spread, you're only paying $39. And so that is a huge benefit for traders that are trying to grow their accounts, replace their income, and they might not have a lot of money to get started. That's one of the key benefits of this strategy, and we use this all the time at Freedom Income Options Trader. So it also has a higher profit potential. So since you're buying, your max profit is greater than your initial cost, and it works really good in strong uptrends because you can get a good risk to reward. Now, there are some risks here. Number one is with the put spread, if the stock goes sideways, you're good. But with the bull call spread, it's got to go up, right? And the way that we do it, we have a way that gives us high win rate with the bull call spread, and that is we go for small targets, right? So a small little pop and we're out, right? But it's still, even with that little trick that we use, it's still not as high probability as the bull put spread. And so what we do at Freedom Income is we balance the two. We're trading both strategies to help us grow all the time. Now, a back test had been done. We are always looking at statistics and back testing. A back test had been done on this strategy, and what we found was the bull call spread was more profitable over a 10-year period than the S&P 500, even though there was a much lower winning percentage. So I'll show the slide here, but 94% of the trades were won on the bull put spread, 79% on the bull call spread. And yet, even with a smaller winning percentage, you still made more money because you made more money on each trade. So in that case, this is a high-powered strategy that doesn't take a lot of money to get started. You can trade this with only $39. It's a great strategy if you use it properly and you find the right stocks. And so if we take a look at this last chart, it kind of gives you the comparison of the two. It shows the bull call spread versus the bull put, and you can see here on the bull call spread, the potential of profit is 45%. The put spread, the potential of profit is 75%, and growth on the call spread is more. And so over time, though, we found if you're using a bullish, very strong chart, really good stock selection, the bull call spread will make money faster. But as a freedom income option trader, we want to try to replace our job. And in order to replace our job, we've got to be consistent. And so we balance it out, and we're always balancing and looking for the two trades because we want to grow our account. So in your specific situation, I would try these two strategies out. Let me know in the comments if you have experience with either one of these. I recommend that you try them out. You see which ones work. If you're just starting out and you need an account to grow quickly, go ahead and try the bull call spread. See if you can use that to grow your account. If you need help, just let us know. Or you could try a hybrid strategy, kind of like what we do. And if you have found interest in this content at all, we'll continue to post more detail on how to trade these, because this is a very brief overview. All right, thanks a lot, and I hope you enjoyed this training. Hopefully it helped shed some light on these two strategies.